shareholders versus partners. Do you agree? And based on the rights and obligations of the partners, it would appear that a partnership might rather be a joint operation, whereas a company might rather be a joint venture because of the separation. All right, and that's why I say to you that I feel the idea with a joint venture is to create an autonomous entity in which we have an interest where we want to invest into that entity, and we are entitled to the net asset value of that company according to our percentage, all right, or our right to that part of the net asset value. Whereas with a joint operation, the idea is not to create autonomy, but rather to create an extension of the joint operator. And that's why separation is not a priority there. All right, let's move on to slide number 17. And this is what we basically discussed now. Classifying joint arrangements. You can see we're still busy with that. Where separate vehicle does exist, how do you determine joint venture or joint operation? Look at what I'm saying here. Assess the parties' rights and obligations arising from the arrangement, considering the legal form of the separate vehicle. We did that. Company versus partnership, all right? The terms of the contractual arrangement. So there might even be a contract here that creates this separate entity. Remember, a separate entity is contractually agreed upon. Do you agree? So it doesn't have to be a company. It doesn't have to be a partnership. It can be something else that is created by contract. And that makes it even more important to determine what do the parties have rights to and what do they have liabilities for. All right. And then other facts and circumstances that may play a role. If the legal form of the separate vehicle does not confer separation between the parties and the separate vehicle, a joint operation is formed. For example, a partnership. Now remember, this is in its simplest form. I'm always saying take account of other facts and circumstances. So I'm lecturing to you based on the simplest form of the way that these things are classified. There are always unique things that you can throw in and say, yeah, but if this is the case, then that is not a joint operation. All right, so just be aware of that, but in its simplest form, that last bullet is correct. If the legal form of the separate vehicle, like a partnership, does not confer separation between the parties and the separate vehicle, so it doesn't separate the partners from the assets and liabilities of the partnership, all right, then a joint operation is still formed despite the fact that there is a separate vehicle. All right, let's go into slide number 18. A joint operation is effectively an extension of the activities of the joint operator. A joint venture is a separate venture or entity which is not a mere extension of the activities of the joint venturer. A joint operation is likely to be set up to complete one specific project, whereas a joint venture is likely to exist beyond one specific contract and is an autonomous entity. All right, so these are all the things that we have discussed already. Now, if we move on to the final slide of this chapter, classifying joint arrangements, we're still busy with that. Ultimately, the rights and obligations of the parties indicate the type of joint arrangement, rights to the assets and or obligations for the liabilities. You can see that's what it's all about. Now, let me just give you some examples here. Commitments that the party makes to purchase or, let's say, the inventory produced by that company. So what does that company have a right to? The inventory. It has a right to the assets. Does that sound to you like a right to the net equity of the company? No. So even if there is a separate vehicle, if there's a commitment to purchase all the outputs produced, that would be a joint operation. Because what can you see here? Rights to assets, rights to outputs. So the focus is on the rights to something specific, not a separate entity in which we invest and obtain an equity interest. Okay. Second one, continued provision of cash flows for operations and expectations to fund losses. Those are all examples of joint operations and not joint ventures. Because if we carry on funding the losses of the joint arrangement, all right, then that means that we are specifically responsible for the liability. Do you agree? The liabilities that we're going to pick up, we pick up obligations. And that means that it's a joint operation, all right? Whereas if that entity functions on its own and it's autonomous, it's a joint venture, there'll be a focus possibly on that entity obtaining its own finance. Okay? And that entity being more distant and separate from the joint venturers and not so dependent. So I think it's very important that you look at the dependence of the joint arrangement on the parties to that joint arrangement. The higher the dependence, the more likely it is that it is a joint operation. And the lower the dependence, the more likely it is a joint venture. All right, I think you're starting to get the idea regarding this classification. Then there's just one thing that I want to point out. A commitment upon default and a guarantee that a party provides. Those are not indicative of that joint arrangement being a joint operation. Why not? Because they are not unconditional. If I say that I will make a commitment upon default, let's say the joint arrangement defaults on its loan and doesn't pay back the loan to the bank, then I'll stand in and I'll pay that loan back to the bank. What am I doing? I will stand in if there's breach of the original loan agreement between the operation and the bank. Can you see? That doesn't make it on its own a joint operation because it's not unconditional. It's dependent on the joint arrangement firstly being in breach of its loan agreement. Can you see? The second thing, let's say the joint venture applies for finance from a bank, all right? And we stand in with a guarantee that if that amount is not paid, we'll stand in. That's the same as a commitment upon default. Very similar principles. If we provide the guarantees so that the loan is then granted to the joint venture, that guarantee doesn't mean that we are personally taking responsibility for the loan. It's only in the case of breach that something is going to happen. So it's not unconditional, and therefore those must not be used to classify something as a joint operation. Ladies and gentlemen, in Chapter 4, I would like to have a look at, once we've gone through the classification process, what would now be the accounting treatment of joint operations and joint ventures. What do we do once we've performed the classification? We've come to a result, and we know we have a joint operation or a joint venture. Let's move on to slide number 21. Joint operations. Let's have a look at the information that is provided. A joint operator, that's the party in a joint operation, recognizes in relation to its interest in a joint operation. That means according to its percentage that it takes responsibility for. Do you agree? That it has a right or an obligation for. Its assets, its own assets, plus including the percentage of assets held jointly. Okay? Its liabilities, including the percentage of liabilities incurred jointly, its revenue from the sale of its share of the output of the joint operation, its percentage of the revenue from the sale of the output by the joint operation, and its expenses, including the percentage of any expenses incurred jointly. The joint operator accounts for the assets, liabilities, revenues, and expenses in relation to its involvement in a joint operation in accordance with relevant IFRSs. A party that participates in but does not have joint control, that's one of the other three. Can you remember from our example? They're not part of the contractual two that basically control jointly this joint operation. So it's one of the other three parties. A party that participates in but does not have joint control of a joint operation shall also use the above if that party has rights to the assets and obligations for the liabilities relating to the joint operation. So, ladies and gentlemen, what you see in front of you, you can also go and have a look at the chapter in the textbook group statements, because there they will show you the difference between joint operations and joint ventures. Now this, what you see happening in front of you, is basically the proportionate consolidation method. Now the issue that arises here is it the proportionate consolidation method in full or not? Now what you will see is, if I say to you that the joint operator has a 50% interest in all assets and all liabilities, what does that mean? That means that 50% of assets will be brought in, 50% of liabilities will be brought in, and that is what the proportionate consolidation method used to do. Do you agree? So then we're going to actually follow the proportionate consolidation method. But if I say to you that this joint operator has 50% of the assets and 20% of the liabilities, then that is not the proportionate consolidation method that we know from IAS 31. So that is why the answer is yes or no. And I recommend that you go and have a look in your group statements textbook at joint operations and joint ventures and what that actually physically transpires into. That's very important that you have a look at it, because it sounds very easy. Bring in your assets, bring in your revenue, bring in your liabilities, bring in all of those things at the relevant percentages that you are, enabled to take, or that you have a right to, or the liabilities that you have a percentage of obligation to, etc. Sounds very easy to do, but look in your textbook and make sure that you understand the practical side of how to do that. Let's move on to slide number 22, and that is what we're discussing now. Is proportionate consolidation the same as the new accounting for joint operations? Sometimes yes, sometimes no. If the investor holds 50% in all assets and liabilities, then it's similar. If the investor only holds an interest in specific assets or liabilities, or holds different interests in different assets or liabilities, 50% of assets, 20% of liabilities. Sometimes in certain assets, there's no interest. In other liabilities, there might be no obligation. That's a very mix and match approach. Do you agree? That would not have been possible under the proportionate consolidation method. The proportionate consolidation method said all of your assets, all of your liabilities, one percentage, and that's the percentage that you bring into the joint venturer's books. Now, that is not the case anymore. Do you agree? So as long as there's a difference in interest between assets and liabilities, some assets are included, some assets are not, we cannot just go and apply the proportionate consolidation method straight out. All right. Now, the financial statements of joint ventures, let's firstly have a look at the principles. A joint venturer recognizes its interest in a joint venture as an investment and shall account for that investment in accordance with IAS 28 investments in associates and joint ventures. Now, what is important here? Ladies and gentlemen, do you see that IAS 28's name has been changed? That used to just say investments in associates. So now it's investments in associates and joint ventures, unless the entity is exempted from applying the equity method as specified in IAS 28. So under certain circumstances, you know your IAS 28. Under certain circumstances, you don't have to apply the equity method. So now what happens? If you have a joint venture and you are one of the controlling joint venturers, all right, you are supposed to use the equity method to account for your investment in the joint venture. All right, so we know the equity method. It is a revaluation basically that's done of that investment based on the underlying net asset value of the joint venture. Do you agree? So we're going to say this is the fairly stated NAV, and therefore that will also give you the fairly stated equity of the joint venture. Do you agree? And then we multiply our percentage of that, and that means since the cost price of that investment, it has now grown or it has decreased by 50% of the growth in the net asset value or the growth or decrease in the equity. Do you agree? So it's basically, don't get scared of the equity method. You're basically just using the net asset value of the company to perform a revaluation or a fair valuation of your investment in an associate and your investment in a joint venture. So it's actually not difficult. You'll see just now what I say about that journal entry. All right, so we know now that the joint venturer, that's one of the two parties that control the joint venture, okay, contractually share the control. Do you agree? One of those two parties, they will then equity account their interest in a joint venture. Now, a party that participates in, but that does not have joint control of a joint venture, accounts for its interest in the arrangement in